Welcome back to A Week in Markets. George Bell here, Portfolio Manager, and I'm joined today by Joe Forward, one of our investment analysts. Quite a bit to unpack on today's session.
Yeah, there's been a bit of market volatility, but we have seen some strength coming through in the data.
Yeah, absolutely. I mean, let's look at some individual asset classes. So global government bonds, they've actually returned around 1% so far in the week. And if we look at the month of August so far, up around 2.5%. And the real strength seems to be coming through in the US market, longer maturity bonds, which are really in focus there. Higher quality global corporate bonds have also provided a positive return as well. They're up around 0.85% for the week and then 2.1% for the month so far. So positive returns from fixed income, but also from the equity market as well. If we look at global equities, they're up around 1.1% through the course of the week. And the key areas of support are coming from Europe and also Japan. The US has been, as you mentioned, a little bit more volatile. We've seen quite a bit of focus on the employment data and what this means for the pathway of the economy and also how central banks are going to respond with interest rates. At this point in time, we're seeing a bit of a cooling of the labour market, and that is directing the Federal Reserve towards a pathway of actually starting to bring interest rates down. And the sort of sectors which have done well over the course of the week in this environment include healthcare, utilities, but also areas like materials as well. So you're seeing returns coming out of quite a broad set of sectors. So all in, it's actually quite a constructive backdrop of returns for a multi-asset portfolio. Returns coming from equities, coming from bonds, but also a number of other areas which we haven't even covered there, such as alternatives and gold there. So can probably get into the detail of this as we work through the session today.
Yeah, could you take us through just some of that employment data in a bit more detail?
Yeah, absolutely. I mean, this has really been in focus, particularly in the United States. And earlier this week on Morning Markets, I talked about a revision to the number of citizens who are on payrolls in the US. And this is a survey which is done by the Bureau of Labour Statistics. Now, they can get it wrong. They can overestimate, they can underestimate, but it was quite a sizable revision which we had earlier in the week. Actually revised the number down by 30%. So around 818,000 fewer workers actually on payroll in the 12 months to the end of March than actually what they first put out there. But it's still a really strong job market. Still added over 2 million jobs in that period, even after you factor in the revisions. It's just another signal that we are starting to see a bit of a cooling of the labour market. Even there today, we had the initial claims of unemployment support for the week, and that actually ticked up by around 4,000 for the course of the week. So 232,000 additional citizens claiming for unemployment support. And if we look at unemployment levels in the US, we're currently sitting at 4.3%. Now, that's ticked up from around 3.5% where we were this time last year, but it's still in the lower bounds of what we've seen over the last 50 years. And actually, some of the fact that unemployment has ticked up is because you've got more workers who have re-entered the workforce. Your supply levels have gone up as well. So employment's going to be in focus. It's in focus of the Federal Reserve minutes, which we had this week. It's also going to be in focus for Jackson Hole. Right now, we've got Jerome Powell, who's speaking at the Economic Symposium at Jackson Hole now. And the focus this year is, reassessing the effectiveness of monetary policy. So there's a lot to unpack there. So I'm looking forward to digesting that and bringing it to life next week. We also had the PMI data as well in the US. What were the key takeaways there?
Yeah, so the key takeaway is that the US is still expansionary and it's firmly in the expansionary territory, but we did see a bit of a difference between the two elements that it split out into, so that's manufacturing and services. So manufacturing, a bit softer, probably a bit of uncertainty just around the election. And with that, you actually see sort of orders not coming in as much as they'd anticipated and stock building up in warehouses. What this means is that manufacturing companies really aren't looking to add new staff at the moment and therefore aren't particularly growing. But you're actually seeing the opposite in services. So services companies are actually a bit more excited about the fact that inflation's coming into a bit of a more reasonable sort of level. You're also seeing interest rates looking like they're about to come down, hopefully in September. It's looking like we'll get that first cut. So they're actually really optimistic about, their orders are coming in, and it'll actually look to continue doing that as well. But something that I had a look at just this week was around some of the corporate earnings. And a part that we like to look at a lot is just around sort of the consumer spending element, given that's such a key component of, you know, the GDP in the US. And when you actually look at some of the company earnings, you know, they give a bit of guidance into something that we call sort of consumer resilience. So how resilient has the consumer been? And if we think about sort of the inflation they've had to put up with over the last 2-3 years, you know, they've had a lot to deal with. So it's key to kind of have a look at what companies are saying. So we'll just dive in. So the first company I looked at was Walmart, and you know, they actually, what they've been doing this year, they've started to discount a lot of the products and give sort of deals, and they've actually started to reap the reward from this, and they actually revised their sales estimates for 2024 up by a whole %, which is quite a significant amount to raise them by. So, you know, positive for them, and their share price reaction on the day was 6.5% up, so positive. If you look at sort of other companies, you know, it wasn't just sort of a one company story. You had Target as well, similar kind of company. Again, they did exactly the same thing, giving discounts to customers, giving deals, and essentially their sales are actually up year on year in Q2 by 2%, so a good number for them. And then if you look at the share price, it's quite phenomenal, so 16% rise on the day in the share price, which is ridiculous. But, you know, we do want to have a bit of a balanced story, so we contrast this maybe with someone like Macy's, who are a department store, maybe a bit more of sort of a higher end goods store, and they actually had quite a big disappointment in their sales. So, you know, with them being sort of higher quality goods, analysts were expecting a decline in sales, but they actually declined by even more than the market was expecting. So you saw a real sort of decline in the share price, off 12% on the day. And a lot of the commentary that came from the company was just saying, you know, the consumer is looking to trade down, looking for the deals, looking at sort of wise places to spend the money. So there is still consumer resilience, but maybe just looking to be more clever about where they are spending.
And I think that's one of the themes we've actually been guiding to on a lot of our morning market updates, the fact that consumers have put up with a lot in terms of the pass-through of costs, and they're becoming more discerning in terms of where they spend, and those businesses who are more dynamic and able to actually respond to that through discounting or loyalty schemes seem to be reaping the rewards there in terms of what their projections look like as a business. We had a actually similar sort of dynamic in the European Purchasing Managers Index as well. So what we saw there is the strengths really still coming through from services relative to manufacturing. If we look at some standout examples, France was one of the key regions where you saw a big pickup in terms of the servicing index. So it moved from 50.1 to actually a level of 55. Now, that's quite a material jump there. And one of the key aspects there is, of course, the Olympics and the support which that offered to hotels, restaurants, bars and transportation there. But underlying is still a trend that services are really quite important to propping up economic growth.
Absolutely.
At this point.
And I think we saw some data come through from Japan as well.
Yeah, absolutely. I mean, Japan, it's been in massive focus, particularly how central banks in Japan are talking about inflation and ultimately what they're going to do about it. You know, we've seen inflation which has been above the central bank's 2% target. We saw a surprise interest rate hike last month, which wasn't digested too well by the market. So just this week, we've had some reported data, core inflation 2.7 from 2.6. Now, one of the key aspects which is driving that increase is the fact that you've seen the phasing out of some of the subsidies to support energy costs for households. If we look at the index stripping out energy costs, that's actually at 1.9, so that's below the target. Now, the way in which the Bank of Japan actually discuss this is going to be quite important. You know, they don't want to create any volatility in the markets. They're recognising that they do need to bring inflation under control, but taking lessons from their approach last time, they want to do it in a way in which the market is very understanding of what they're seeking to achieve and the sort of direction of travel. So probably a much more careful approach in terms of the language from the Bank of Japan from here, so they don't create as much volatility. Even as we look into next week, quite a number of aspects which we'll be discussing as a team. What are the key ones for you, Joe?
Yeah, so like we mentioned, we've got the Jackson Hole Symposium going on this weekend, and we really will be looking at how the market digests those. So will be something that we're really looking at next week. Will be key for us. We've also got some European sentiment data, which should give us a bit more of a grasp on the European economy, like you just described there from the PMIs. And then finally, we've actually got the PCE number coming through, which is the Fed's chosen measure of inflation. So despite the market maybe focusing a bit more on growth at the moment, still really important that we monitor those inflation numbers as they come through.
So a busy week. Hopefully we've been able to summarise some of the key points for you and also what we'll be looking out for next week. Joe, thanks very much for your session there. Look forward to bringing you up to date on Tuesday on Morning Markets.